Hey, this is Anthony, and I'm the host of What They Did Not Teach You in School, the podcast that interviews people to get their wisdom recorded so that hopefully you could learn some things that are not taught in school, but should be taught in school. I'd like to remind people that a lot of the things talked about on this podcast relate to investing and finance. The purpose of talking about these subjects are to hopefully inform people and educate them on financial literacy, and to entertain people with some do's and do nots. This is not to be considered financial advice. Before trying anything that you learn on the podcast, be sure to consult a professional. Hello, and welcome to this week's episode of What They Did Not Teach You in School. Today, we have a very special guest on the podcast, someone who you've seen before, Pirasaanth Varatharajan. This is episode number 4 that we've done together.
Let's go, man.
You're one of my favorite guests, which is why you've been on so many times. The last episode that we released was on May 30th, 2023. It was just me and you, and it was in our old podcast studio.
Right.
The first episode we did together was in 2019, I believe, and that was with Emma.
Yep.
And then we did a special virtual episode during the pandemic.
Yeah, pandemic special.
With you and Mitt, which was really good.
Yeah.
So, yeah, man, I'm super happy to have you on today.
Amazing.
And before we get started, obviously the last time we spoke or had you on the podcast was 2 years ago, over 2 years ago now. So what has happened since then? What have you been up to?
Yeah, for sure, man. First of all, thanks again for having me on the podcast, man. I always enjoy being a guest here, and it's an honor. To answer your question, what have we done since 2023? Well, 2023 was the year we decided to launch a real estate fund in one of the toughest capital raising environments, especially after the quick interest rate hikes, and a lot of investors had not only gotten burned in the markets across the board, real estate, stocks, everything. In general, investor capital was very tight, and we decided, this is a perfect time for us to launch a real estate fund. So in terms of challenges, a lot of challenges with the fund were associated directly with the time that we launched. So, for the viewers that aren't familiar with what a real estate fund is, we're a private REIT. So think of it kind of like a mutual fund, but instead of buying stocks, we're buying real estate, and the REIT owns it and manages it on behalf of the investor. So that's kind of
like instead of, I always think of it as like it's a pain in the friggin' ass to manage a real estate property. Like I have to like deal with upkeep of the property, plumbing breaks, I gotta fix that, finding tenants, collecting checks, running all the bills, et cetera. And it's only on one property, which then you have like diversification risk there because it's only one thing. But with a REIT, you guys handle all of that for the investor, and they have multiple properties that diversifies their risk.
Exactly. It's a great way for you to own real estate passively and get the exposure to real estate in your portfolio without actually having to deal with any of the tenant headaches and the operations or the various other problems that come with real estate. Everybody knows that real estate is a good investment, especially if you hold it over the long term. But what isn't spoken about much is that, business model in doing real estate is simple, but not easy. Like the actual execution and the headaches, like the numbers and the ROI don't tell the full tale. And a lot of investors end up learning that the hard way, and then eventually decide to put their capital in a REIT so that it's hands off and they have expert management managing the properties, and they get their exposure that way.
So in May, when we did our last podcast, did you start it? It's called Foundation Capital for everyone who doesn't know.
Foundation Capital Private Real Estate Trust. So we had just officially launched, lawyers finished the paperwork and everything. We were live right at March 2023. So we just launched.
So now, how much do you have under management? How many properties? What development have you had over the last couple years?
So now we're at about 8 properties under the REIT, and we've raised a total of $8 million in capital, and we're at $20 million under management. So we've grown quite well.
Yeah, that's impressive for 2 years. But you were an accountant before that. What the heck made you make that transition? What was like the inception for that idea to go and start a REIT? Like the majority of the REITs, especially in Canada, are run by a bunch of old guys, you know?
Right. It was kind of like a natural transition, Anthony. Like this all started when I was at a Big Four accounting firm and I was grinding crazy hours. And, you know, being a CPA at one of the Big Fours, you're actually exempt from minimum wage. So I remember there was times where I'm working like 80, 90 hours a week. I'm doing the math on hours divided by my 45K salary. And I'm like, oh, I'm making less than minimum wage, even though I'm about to be a CA. So very quickly I decided, what's a better way for me to build wealth? Am I really gonna grind like this until I'm 40 one day and I'm a partner? Or, you know, if you become one of the more successful accountants, you're a CFO, and then that's when life starts. And that's how I came across real estate investing. You know, a quick Google search, and they say that's one of the best ways to build wealth. So, you know, fast forward, I get into real estate investing. Personally, yeah, just in order to build wealth, collect assets, and then one day these things are going to be worth a lot of money, and you know I can eventually retire, is how I kind of got into it and started dabbling with condos and things like that. And then across the journey learned more technical real estate investing, such as the BRRRR method, which we'll get into down the road. So slowly started scaling up a personal portfolio with my partners, and we grew our private portfolio to a sizable amount. We got into the apartment building space, and it was a great way for us to earn passive income so we could retire early, was kind of the reasoning behind it. So using this strategy, we scaled that portfolio up and we were doing really well. But we started to see with a lot of the bigger deals, you need a lot more capital to do it. And you know, their time horizon for us was based on how quickly we can execute on projects, how quickly we can turn over our capital and grow this portfolio. And in order to do that, it would take a much longer time versus if we launched a vehicle such as a REIT and essentially had investors come in, and we have a proven strategy that works and use that capital to grow this at a much bigger scale. We give up a good chunk of the ownership position as the investors own it, but the deals are much bigger, and you're doing it at scale. So that's kind of how we transitioned into the REIT model.
A wise mentor of mine used to always say, it's better to have 50% of something than 100% of nothing.
Yeah,
so I can understand, in order for you to maybe move faster or like whatever and own the entire pie, you know, you would have done it on your own, but to go further and bigger, it would have been made sense to do this REIT.
Yeah.
Now,
exactly.
What is your strategy? You said you have some kind of strategy. How do you add value into the properties?
Yeah, for sure. So the primary types of properties we're looking for is things where we can do the value add strategy using what we call the BRRRR method. So the BRRRR method stands for buy, renovate, rent, refinance, and repeat, right? So we're looking to buy buildings which are underutilized in terms of net operating income. So if I were to simplify, let's say we're looking at a 50-unit building and a bunch of the units are rented out at $600 a month and they're old and outdated, we would go ahead, purchase that building, get a number of those units turned over, renovate them, make them much nicer, almost like Toronto-style condos, put in-suite laundry in them, make them a much better rentable product, and then rent out those units at $1,800 a month, which would significantly improve the net operating income of the building, which makes the building worth a lot more money. So on average, you know, given the cap rates in the areas that we're operating, each unit you turn over, you're able to increase the building's value by $200,000. So if you turn over 10 of the units, you just increased it by $2 million, if I'm keeping it in simple terms. So we do that, we improve the value of the building, and then we refinance it, get the capital out at that new valuation, and then repeat the process. Go and deploy that capital into another building, which you can do the same thing. And after it's been refinanced, the building is able to pay a strong cash flow and continues to generate our investors a return.
Yeah, I love that. And like, so does every REIT have that strategy, or is this somewhat proprietary to you guys?
I wouldn't say it's proprietary to us, but there are REITs who execute the same strategy, but different REITs are in different types of investments. So you have REITs that can be just purely for development. You can have ones that are purely in office and commercial space. You can have ones that have a lower yield, but they're buying buildings that are already been stabilized, already yielding a good rent, and then it's paying like a 5 to 6% return, and it's just steady like that.
So that would be like more less risk on those types.
Well, not necessarily less risk, but there's less work required for the management of the REIT, right? So if for example, if you're a fund manager, you have a lot of capital and you don't want to put too much groundwork into it, it's easier for you to just buy the building and let it do its thing, and then it yields a 5-6% return. With our REIT, we target a 15% return. So we need to go in there and do a lot of work to make sure we're getting those turnovers, we're successfully executing on those projects and improving the value of the building. And for those efforts that we're doing, that's why we're able to yield that 15% targeted return.
I understand that. So, something I want to point out is your guys' social media strategy, which I've been following over the last 3 years, which for anyone who follows Foundation Capital or PV himself, they actually show themselves going to the building and like, you know, this happened, something broke or whatever, and they're like, fuck, we gotta like fix this now, you know? And you bring people for the ride, which is, I think, super authentic. And in a world of like everyone trying to flex or like whatever, you guys take a more like boots on the ground approach where you show the good and the bad.
Yeah.
And you guys are not just some guys in suits in a Bay Street office in Toronto, you know? What made you guys take that approach?
I think
was it like intuitive to you, or
I think part of it, Anthony, was just who we were as people. Like, you know, we definitely were building out the business so that it would be hands off and us as management wouldn't have to worry about these types of problems. So we put the right staff members and stuff in place. But in general, we just are like being very hands-on operators when it comes to this stuff. So, you know, with our business, there's two pieces. There's the actual operating and management and execution of the buildings and the projects, and then there's the raising capital side, you know, which I think we're very good at both. And we, even though we could, in theory, delegate the full management of the operations, we enjoy doing that, and I think that's just how we were when we grew our private portfolio. And we bring that same grit and boots on the ground approach to the REIT. So when it came to the marketing side of things, you know, I'm looking around all the quote unquote Wall Street / Bay Street type REITs are, you know, they're very much in their suits. It's completely passive. You know, you're managing real estate, but as an investor, or the way they're marketing is, it's kind of like you bought a stock where you don't see it, touch it, or feel it. There's your annual reporting.
Which is probably the majority of people who work at REITs.
So, you know, for us, we very quickly realized that a lot of our investors want to own real estate without having the headaches or having to deal with the BS that comes with it. But even though that's the case, they still want to feel like they own the real estate. So, you know, we're already taking this boots on the ground approach here, managing the properties and, you know, staying very well informed on what's going on. Why not just share this with them too, so they can see, this is the types of headaches and this is the kind of things going on, but okay, don't worry, it's all being taken care of. And that way they still get to feel like they're an owner in the building and be along for the journey. So we just started to see that was working really well and wanted to keep leaning into that based on it starting with our natural intuition.
I think it makes people trust you more because you actually care and you're not just some people who are just moving numbers from like one balance sheet to another, but you actually like go and touch and feel and are a part of and are empathetic to the development of the properties that people are invested in. And I think that makes you unique and different.
For sure.
But it also makes people proud of investing because they see what it's actually like to own the physical property, which you don't get in a lot of other REITs.
Right. And I think this also allows us to keep a close eye on the execution, right? Like with the strategy we have, it only works if you actually execute it. I've seen too many, not even REITs, but also just other investors in similar types of buildings doing the similar type of strategy where they have a great time raising capital, but they're not actually executing on the project. So if you don't actually execute and you're not able to recycle that capital or even actually generate the return you're promising to your investors, the whole thing doesn't work, right? So I think being able to ruthlessly execute is very important, and that's why we want to keep a close eye on the actual operations.
I agree.
Of the building.
I understand that. I want to switch gears a little bit towards like you being an entrepreneur scaling a business. So for Foundation Capital, what's your vision for Foundation Capital?
Yeah, so right now, like I was saying, we're at 20 million under management. The next big milestone is we want to get to that 100 million under management part. And from there, I think that's when the real exponential growth happens, because then you have institutions looking at you and making investments in. And like, let me put it to you this way, Anthony, when you're growing a REIT or a real estate fund, like that first grind to 100 million is very tough. Similar to, actually funny enough, it reminds me a lot of if you're growing an accounting practice or an agency, et cetera. Like that first momentum building is very difficult.
Yeah.
But once the snowball gets to a certain amount, it's just crazy, right?
Once you get to 100 million, you'll be doing what you've done in the last 3 years in 6 months.
Yeah. So they say, like, I've seen some funds where it took them 5-6 years to get to 100 million, but once they made it to 100 million, they were at $1 billion in less than half the time.
Yes,
so
that makes
I'm
sense.
looking forward to that kind of that growth, and just taking this thing as far as we can.
Yeah. What motivates you as an entrepreneur to like get that big?
Yeah, well, for
You
me,
ever do
I
that
think
reflection?
Yes, I have done that reflection. And initially, it's not the money. I think, at a certain point, you're comfortable, and I'm an ambitious person. I think finances aside, just being able to build something from scratch that, hasn't been done before in my family or in my immediate circle, I think is what drives me.
Cool. I like that. And what over the last 2 years, what's probably the biggest challenge that you faced that maybe people listening right now can learn from?
Yeah, I think the biggest challenge that we faced as a business was, of course, raising capital in such a difficult environment. You had so many competing interests, right? Like if you think about the product that we offer, if you put the risks aside for a second, like what I'm selling you is you're making more money, right? Like you put your money with us and you're going to earn a 15% targeted return. Like that should sell itself. However, you're competing with a lot of different things that you don't even realize. Like, well, given the state of the economy, people are a little scared and on the sideline about, the real estate market, how things are looking. Should I put investing my capital or not? You're competing with other REITs, but also you're competing with other material objects. Like a lot of times people aren't focusing on building wealth and investing. Like you're competing with the BMWs and the Gucci's of the world on where consumer spending is happening. Like I've just learned a lot of times, regular retail investors and individuals who have primarily been our investor base up until now, don't put that as a priority, and would rather spend on the material item now than invest their money and grow, right? Obviously the more astute ones who are business owners who understand the picture, know what's up, and they know the power of building wealth and investing. So it's that's been an interesting journey, being able to overcome that, especially in times like this.
Now, how about you as an individual, as an entrepreneur? I want to know, like, what probably was the hardest part or hardest moment that you had to overcome or pivot, especially coming from being a CPA accountant, running an accounting practice, to now running a REIT. Very different similarities, but very different from what you have been doing on a day-to-day, and also you trying to scale as a business owner and entrepreneur.
Right.
What was the hardest moment for you over the last 2 years in growing this thing?
I think learning the sales and marketing component of it. Like, as an accountant, Anthony, my partner is an accountant as well. We bring that numbers-driven data approach to the execution of the business. That's why we're able to buy good deals, make sure the deals execute well on the timeline that we forecasted, and generate our return for our investors. And we're great at doing that part. But that's only one piece of the business. There's the sales and marketing piece. So even though we have this great product that works and the risks are mitigated, how do you convince this person to actually put their money in and invest? You have to do a good job marketing this product. And unfortunately, the number 15% targeted return doesn't sell itself all the time. So getting to understand our target type of investor and how they should be marketed to, even how I would pitch them, when I have interested investors coming in and we're doing initial investor calls and getting them to understand the investment. When I first started, I put the accountant brain on and be like, okay, this is why your risks are mitigated. This is our strategy. This is the forecasted approach we use. And because of all these things, accountant PV would be like, oh yes, these numbers make sense. And it should sell itself, right? But your average investor who doesn't understand a lot of these terms, or they don't care about my forecasted model, how do I get them to understand what the REIT is and what it can offer you. So that was a big learning curve for me, and as well as just even the marketing side of things for, you know, digital marketing to get people to, aside from our social media content, but even things like the Facebook ads and driving traffic was a learning process on how we want to speak to our end investor, not the way I want to be spoken to myself. Do you know, does that make sense?
100%. A couple key learnings there that are universal in every business is that the number one skill that someone can have is sales and marketing. Whether you're an engineer or an accountant or a portfolio manager, still, if you're the best REIT in the entire world, but no one knows about you, it doesn't matter.
Exactly.
Second thing is that people don't resonate with numbers and statistics and data. They resonate with stories and empathy and emotion, right? And you probably had to learn that in selling somebody on investing in you versus buying a Gucci purse, right? Because Gucci does a great job in selling the story of why their purse is a good investment. And now you have to compete with that, and they don't really care about a 15% rate of return. They care about what is the story behind investing in foundation capital and what's that going to do to them.
And to add on, Anthony, also finding a way to do that in a way that resonates well with you.
I was going to say,
other scummy people paint the story of like, oh, your kid's school's going to be paid for, no problem, and sell them hopes and dreams to get them to invest and then not deliver on it, right? Which, you know, that approach does not sit right with me at all.
Especially over the long term, it never works. But like, that was going to be my third point as well, is empathy. Empathy in the person that you're trying to service and speaking to them in the way that they want to be spoken to, not necessarily how you would want to be spoken to. Those are some universal skills that are not taught in school.
For sure, man. Yeah, and for me as an accountant, I feel like our firm did well because we were good at sales, but not in a traditional way. I think the approach that I previously worked as, you know, as an accountant, I know what I'm talking about. This is the service I can offer you. This is the value I can provide. And I did a good job communicating that, which kind of sold itself. But with the REIT side of things, it is very different how you would need to sell or give an investor the information that they need in order to make that decision.
How did you learn this?
Man, a lot of trial and error, I think. You know, as you're getting a lot of potential leads in and investors coming in and having those conversations, you start to kind of see a pattern and pick up on things, and this is what they care about, this is what they don't. A big piece was, again, PV, simplify it. You know, you're being too technical in your explanations and things like that. So just going into having the lens that, okay, let me explain this to someone who doesn't have the background that I did, right? So trial and error is the honest answer, Anthony.
Honestly, that's usually the best way of people learning.
There wasn't a course or a YouTube video that can teach you this.
All right, so I know we were just speaking about how you went to Japan and you had an aha moment that really resonated with me as well. So why don't we just talk a little bit about that? Like, tell me the story about that aha moment and kind of the journey you've been on since then.
Yeah, for sure, Anthony. I guess before we get to that, let me kind of set the stage a little bit on how this even transpired. So, you know, growing up in my early 20s, I was very much in a grinder mentality, and I subscribed to the concept of delayed gratification, which is, you know, suffer now, sacrifice now, so that you're going to enjoy later. So, man, I was not partying. I was skipping so many gatherings with friends, and just so I could grind and get my career off the ground at the time. So, and each time I missed one of those things and I was having the FOMOs while I'm seeing my friends out and having fun, I would say like, all right, man, you're sacrificing your 20s, but your 30s are gonna be amazing. Like, so many nights, whether it's in the library or grinding. I remember there was one time where I had missed so many family gatherings in a row. My cousin was throwing a birthday party. I brought my PwC laptop to his party and took a room in there and just worked on an audit the whole night, and occasionally went and, you know, cheersed with people and came back. And it was moments like that where I'm like, oh man, my 30s are gonna be amazing, even though I'm missing out on the 20s. So fast forward, the seeds that I planted during that time had blossomed, and, you know, I'm in a great place financially. I've achieved the goals that I wanted to. And I'm like, all right, cool. I have the passive income coming in. Let me start traveling the world. Let me start having some fun. Like, enjoy the 30s like I said I would when I sacrificed my 20s. And, you know, leading up to this aha moment, man. So from, I want to say 2022 to 2024, I was traveling a lot, experiencing all kinds of amazing things. And you know, as a result, my health was really taking a decline, especially.
You went a little bit too far, right?
Yeah, exactly, man. all of the alcohol, all of the partying, all of the fun, etc. And so when I was in Japan this past November 2024, I just looked in the mirror one day and just saw the shape that my body was in, and I kind of had a different aha moment. Like, what got me here was sacrificing the 20s in order to enjoy my 30s. But if I don't start taking care of my health, I'm going to be sacrificing my 40s and 50s in a different way, not financially, but having to be taking pills and all kinds of things that could be a side effect of health issues. So
For sure.
I'm like, man, I need to do something about this and make sure that I'm not sacrificing those years for the actions now. So after that aha moment, I got back, finished out the year, and then January 1st got onto a pretty sustainable but strict fitness.
You look amazing
routine,
right now. For those that have seen you like this time last year versus now, unreal, bro.
Thank you, man. I think the biggest change has been doing things sustainably. Like even before,
I was gonna say, like, give some like tips or things about this sustainable kind of like changes that you made.
Yeah. So like every time in the past, I've always cut weight. I did something extreme, whether it's a crazy intermittent fasting window or a keto diet or completely cutting out carbs. Like, you know, you immediately want to see results. And I'm someone that has good willpower and good discipline, so I'll do this extreme shit for at least a month or two, and that's the max I'll go. But you know, I'll do the unsustainable stuff, get results, and think, okay, this is what works. But then obviously the minute you stop, it crashes and it all goes away. So this time I took a different approach where I'm like, I'm not on a timeline. Like, you know, I'm putting that hat on. Like, I'm doing this for my 40s. I'm doing this for my 50s. I don't need to have a six pack by 6 months from now for a wedding shoot or something like that, right? So I can take my time, and I took a sustainable approach, knowing that that's what's going to allow me to keep it off this time. So big thing for me has been the walking. I get 10K steps a day at least, counting and tracking the calories, but I'm not cutting the carbs. Like, you still get to eat things you like as long as it fits within that daily allowance you have to spend. You're good to go. So I think
how do you get 10,000 steps a day?
So you have
It's a lot harder than it sounds.
Yeah. But you know, Anthony, you're an entrepreneur, and my entrepreneurs out there are gonna love this. Is you're able to schedule out your calendar and schedule out all your meetings, right? Why can't you schedule out your walks every day? So for me, literally in my calendar, first walk's at 8 a.m. each day. That's a quick 25-minute. Next one's at 11:30 each day, another 25-minute. And then my last one is at 6 p.m. each day. And then in between, when I go to the gym and stuff like that, there's some steps there too, which gets me to the 10K.
Oh, wow. So it's about an hour and a half of like intentional walking mixed with organic walking throughout the day.
Yeah, exactly.
I do think that's a big hack. Like on days that I get over 10,000 steps, I physically feel better versus the days that I don't.
Yeah, for sure, man. And then there's just other little tricks too, like taking the stairs or parking your car far away and stuff like that. But I find the most effective has been scheduling it, because then you're regimented as well, right? And then when the weekend comes and all bets are supposed to be off, you still have for me, actually, it's easier to slot them in because I'll just get the walks out of the way earlier in the day and then go out and do your evening plans or whatever it is.
What's been like maybe like one or two like game changer hacks besides the walking that's made it more sustainable this time versus other times that you've tried?
Yeah, I think what also has made it more sustainable this time is, I think, building momentum in what I call the off season. So oftentimes, like, let's say you're going to start a cut in the summer, there's always things happening and there's always events. It's going to be harder for you to say no and build that discipline. Like when I started in January, I was like, okay, you know what, at least for the first month, I'm not doing anything. And I actually didn't even drink for the first 3 months of the cut. So I went dry, and that kind of helped me build momentum and got used to me saying no to things or not falling off track. Then once you've gotten that initial period out of the way is when you can add more balance in, and like, okay, now you can have a drink occasionally and things like that. So that I think was a big hack, building momentum. It's very momentum based, the same way business can be as well.
100%, because once you kind of like get addicted to it, where you're just like, oh damn, like I don't want to break this, you know, from a psychological perspective.
Yeah, and then one other thing is, I would say, like, less is more, and it's so true. When you overtrain, you're less likely to do it sustainably. Or for example, you know, I don't run or do any intense cardio. And let's say if my that if I were to replace all my walks with runs, there's gonna be so many days where you're tired and you're beat up and you're gonna skip your run.
Yeah.
But walking is so easy that like no matter how tired or lazy, I'm like, okay, it's just a walk.
Yeah.
And then I get out there and go, and you can do it every day. So like doing the activity over a longer period of time versus the high intense stuff less frequently, I'm gonna take the first one, you know?
I agree. And I think for me, what's made it super easy for me to do, because I do like long walks on 3 days a week, is I just go to the gym and I put on a little YouTube video and I just do an hour walk.
Nice.
And that's I did that this morning at 6 a.m.
Amazing.
And I watched like the F1 race from the weekend.
Yeah.
And I've noticed a significant difference in my energy when I do a long walk versus like an intense HIIT class or like something like that. Like I'm drained, I'm tired. And when I wake up in the morning, just like you said, I go, there used to be a lot of times where I would just click that snooze button. But I go, I'm just going to the gym to watch a Netflix episode or something like that. And I kind of look forward to that walk now.
For sure, man.
That's been a big hack for me. Now, how about things that you've noticed about like your performance at work since because you look like you've lost weight. How much weight have you lost?
I think I'm down like 55 pounds.
Holy shit. Have you noticed anything in your energy, mental clarity, or how you perform at work because of that?
I think definitely the energy is a huge difference. Don't feel as lethargic and tired, you know, more energy throughout the day, which has directly increased my productivity significantly as well. I think I'm able to have like deep work sessions for longer periods of time, stay focused a lot more. So that's been a great benefit. What else? Focus has been good. I think just overall ambition is up too, man. I think just being focused on the business a lot more too versus other competing priorities. I think when you're taking care of yourself physically and you're regimented, that regimentedness, I guess, carries over to the business as well.
Yeah, I can get that. For me, it's like I'm able to do longer hours, and I'm also able to do it at a higher higher pace.
Yeah.
But also, I feel like I'm able to handle stresses better. From that perspective as well.
Sure. Another thing is the sleep. So like, you know, we all know we should be getting sleep, especially as business owners. But you're never like, I'm gonna make sure I get my 8 hours of sleep today so I can perform better at work tomorrow. Right. But when I'm like, okay, no, I need my 8 hours of sleep so that I can get my gym gains, I took it much more seriously. And then the side effect was that was helping the business performance a lot as well. So
True. That
kind of, I guess, got to motivate yourself to sleep.
Yeah, because I feel like you don't notice that, okay, I got 7 hours of sleep, it's okay. But if I have a big workout with my trainer, I always get those 8 to 9 hours for that, and then I just end up working better.
And there's also just this thing we all have as business owners is like when you sacrifice sleep and you're up late night grinding, like this is a great thing. It's like, yeah, I'm putting in the work, you know, but really you're kind of screwing yourself in the long term.
Yes, exactly. Okay, so I'm going to switch gears from health back to kind of Canada's real estate zeitgeist as a whole right now. So obviously in 2010 to 2020, everyone was investing in real estate because you could buy a property for $500,000 and 6 months later sell it for whatever, $200,000 more, $150,000 more. So everyone was investing in real estate. And if you actually look at a graph of real estate prices since 1990 and interest rates, they're directly inverse from each other. So if you were to look at 1990, interest rates were like 8%, 10% for mortgages. A lot of people listening have never like even fathomed that, but our parents remember those days. And ever since 1990, real estate prices, and I want to preface, ever since 1990 to 2020, real estate prices only went up and interest rates never went up. So interest rates only went down from 1990 to 2020 when there was the first real estate, the first interest rate hike. that is generally how real estate prices work. When interest rates go down, real estate prices go up. And especially during the 2010s, interest rates went to like zero or negative interest rates, right? And then since then, over the last like 4 years, people who have invested in real estate have not exactly gotten the best rate of return. Why don't you speak to me a little bit about like that as a whole, like the sentiment around people divesting from Canadian real estate?
Right.
And what your perspective on is there?
Yeah, for sure. I think, because real estate is a leveraged based game, you're borrowing money in order to purchase these assets. The majority of people are not paying cash to do so, and as an investor, it likely wouldn't be a smart thing to do that. So because of when the interest rates went up, the holding costs got a lot more. So for a lot of people who were over leveraged or not in a position to be able to service that debt at the higher prices, they were forced to let go or sell or forced to divest their real estate, right?
Yeah,
so that's one
a lot
piece.
of people that happened to like bought up either pre-construction buildings or had like 3 or 4 properties, but because interest rates went up, they're actually losing on those properties from a rent perspective, and they had to sell them.
For sure, yeah, exactly. And plain and simple, a lot of them were over leveraged, right? So that's one of the big things. And then I think in general, just given the stress that was going through the economy and people's disposable income was getting reduced, things like that, when people were stopping paying rents and tenants were no longer paying rent in order to cover those costs, a lot of these owners aren't able to service the property and keep it on board themselves. Then you add in our landlord tenant board, which is backed up, and it takes forever. Like it could take up to a year or more to get this guy out of your property for not paying rent. People weren't able to stomach that, right? So that ends up causing a big issue when it comes to holding costs, and that's why I'd see a lot of people divest out of Ontario real estate, maybe go into slightly more favorable provinces, or just straight up take it into the US, or just exit the market.
Go into the stock market, because stock market prices have been doing really well over the last 5 years.
Exactly. And
I had a crazy client story where she had a condo in Liberty Village and person just stopped paying rent. It took her 8 months to get that person evicted. That person was just living in her condo, not paying rent illegally for 8 months.
Exactly, man. Those are a lot of the frustrations people have with Ontario real estate, and like a lot of the investors in my fund got rid of their real estate and decided, okay, I don't want to deal with the headaches and the tenants and toilets. Let me just get passive exposure this way. So and we've seen it happen a lot firsthand. So to answer your question, there definitely needs to be some sort of reform in that process. Of course, it's not my place to necessarily speak on that, but a lot of people are unhappy. But for someone like us, this is why our buildings do so well, is because you have a diversified tenant pool. You're not just owning one little single family home. You're owning a building with multiple units, and as long as the majority of those tenants are paying their rent, and you have the capital and the resources to be able to stomach the extended period of times where the tenants are causing you issues, it works well. So it's truly a testament of economies of scale.
Now, do you believe that it's actually like a good idea that people are like divesting from real estate? Do you think that's a good correction?
Yeah, it's interesting. Like in general, Anthony, I subscribe to the thought that if you hold real estate for an extended period of time, you're always going to make money, no matter what, right? The problem is along that extended period of time, you're forced to let go of it, or whether it's because of financial or because of the headaches or whatever. So in general, I think with a long-term horizon, real estate is definitely one of the best ways to go. Not solely be invested in real estate. I think it's also good to be in stocks and other types of investments as well, but you should always have some real estate allocation in your portfolio. But to answer your question, it really comes down to personal preference too. So let's say you are in a position where you don't want to deal with the tenants and toilets and the headaches, or you're a business operator and you're too busy focusing on your business, which is giving you a much better ROI on an annual basis. Maybe it does make sense for you to just purely be in stocks, bonds, whatever, things that are more passive in nature.
Well, my thought process is, one, even if you were in like a more passive portfolio, like one that's like stocks and whatnot, most mutual funds and ETFs have real estate exposure through REITs anyway, which I think is super important. But on this topic, I have a little bit of a thought in that Canadians were way over allocated in real estate over the last 15 years. And this was like a good correction to like still Canadians, I would say, prefer real estate over most investments, which is not the right thing in my opinion. You should be well diversified. But then secondly too, I think like people are just following whatever the latest trend is. So they're going into like the stock market now, right? And I think you should invest in real estate and hold it for the long term.
Yeah,
it's a good thing.
At least a good allocation in your portfolio should be real estate.
What is your outlook on real estate investing in Canada over the next 10 years?
Yeah.
I know we don't have a crystal ball and you can't
right.
like actually make predictions, but like what's your thoughts on it in general?
Yeah, in general, Anthony, I think I'm very bullish on Canadian real estate. And the reason I say that is we still very much have a housing supply problem. Like the demand for housing is much greater than the supply. And we're still not building nearly fast enough to accommodate that. If anything, the current climate with interest rates and the current real estate market has stopped developers from putting shovels in the ground and they're pausing projects.
Yeah, I see
which
that.
is further going to reduce supply. So, you know, fast forward 5 years, especially 10 years, we're going to have a lot less inventory coming online. And that's again going to cause a supply and demand shock where demand is up here, supply is down here, and prices are going to go up. So that's what I see for the long term. You know, for developers or even for us, we're going to be looking to pivot into building purpose-built apartment buildings in order to add supply and help the housing problem here. But it is also going to be very fruitful for doing so because the demand is going to continue to be there, and we just don't build them fast enough.
Yeah, I you know, you always see that in every single market, that whole just like up and down of how things swing like a pendulum. And you know, maybe Canada made it too easy to develop real estate in like the single digit 2000s, and then they had to go the other way, and now they've made it too difficult. And I think a swing back needs to happen in order to actually get that supply, like you said.
For sure.
I forget when it was. There was like a period of time where Toronto had the most cranes in the sky than any other city in the entire world. I think it was like 2016, 2017, something there. And now you look out into the landscape and there's none.
There's nothing, man. Like the developers have definitely taken a beating in this climate, and it just doesn't make financial sense for them to be building right now. But, you know,
that's a
down
shame.
the road when they do, it's going to be very profitable.
Yeah, there's going to be another boom for sure. I think so. For the people that are listening now or watching on Instagram or whatever, we have some recorded, dramatized, real conversations that I've had with clients over the last 3 months. And for those that work with us know that PV is someone who consults with Liberty Horizons on a lot of our clients and does their year ends and whatnot. So we're gonna play some real questions that we get asked, that we've been asked over the last 3 months, and you're just gonna give your POV on it from a by the book perspective and a applicable perspective.
Okay, gotcha.
Okay.
Hey man, quick one for you. I took the missus to Upper 60 last night for the engagement dinner. It was unreal. Anyways, halfway through the steak, I told the maitre d' I'd hook them up with a free social media strategy audit. So I got to thinking, doesn't that mean I can actually write the whole thing off? Like, technically that's BD, right? I think I might have just also closed us a steakhouse account by accident. Let me know if I could send a receipt to finance. Thanks, man.
So what's your thoughts on that?
I mean, technically, he did get engaged. You know, marriage is a business in a sense. So there's something I'm kidding. But, you know, the book says you definitely cannot write that off since that dinner was not for business purposes. However, if he was going to take a client to Harbor 60 to actually discuss business and potentially close the deal, there needs to be substance towards the actual business transaction for him to write it off. So unfortunately, engagement dinners are not going to count. You could do a double date potentially where you bring your fiance and the client and maybe his partner and discuss business over dinner and be able to write it off that way because business is taking place. But just purely your engagement dinner is going to be a no-go.
How would you prove that, like practically?
Yeah, so you know the way,
especially let's say you get audited, and the practical sense of how that audit goes and how you would prove that.
Yeah, you would need to actually show some sort of proof that this was for a client dinner. How they substantiate that can vary. Oftentimes you can show them a calendar invite, an email saying that this dinner was taking place at this time at this place, and substantiating the transaction that way. Sometimes it could be a logbook where you're showing them, here's all of my client meetings that I have throughout the year, and I specifically was at Harbor 60 with this person at that date. So, it's kind of up for debate what exactly it's going to take for them to substantiate it, but they want to see something that's going to prove it.
And the burden of proof is on you.
Yeah.
You're not innocent until proven guilty. You're guilty until proven innocent.
Yeah, exactly. So if they pick that particular receipt and say prove this, and you have nothing, then they're like, okay, it didn't happen.
All right, so here's the next one. This is a content creator that just went on a trip with her partner.
Okay.
Hi, so quick question. If I'm going to say words with my partner, but I'm also planning to shoot a ton of content while I'm there, reels, posts, maybe even a tax deductible tan tutorial, that means the whole trip is a write-off, right? Like this is technically business travel if I'm creating content there. But
Yeah. So with that one, I think technically with the book, you may not be able to write off the entire trip because parts of it are going to be you and your partner enjoying a nice vacation. But if the majority of the trip is you actually filming content reel, you could substantiate the transaction. This one could go either way. It really depends. But if you were asked the CRA, they would say only a portion.
And
but a lot of business owners do this because they can substantiate that the majority of the trip.
Nowadays, especially with content creators and social media marketing agency owners, when they go on these trips, they try to or ask questions about writing it off in order to obviously get some discount on their personal trip or whatever.
Yeah, for sure. So the book says no, but if you can prove it, I'll leave the gray area stuff to you.
Okay, so next one is a business owner who wants to expense their car through their company.
Okay.
Hey, so random question. I was wondering if I can write off a Ferrari as an employee expense. Hear me out. Obviously, I'd only drive it to and from work, maybe the occasional client lunch, and maybe I can even slap the company logo on the hood. So technically, that would count as marketing, right? Yeah, let me know. I'm assuming this does qualify as a legitimate write-off.
Oh man,
You heard that?
I've
There's a lot to unpack there, actually.
I've heard that one quite often because business owners and cars is a match made in heaven.
Yeah.
So first of all, I think the thing you got to focus on is if you're buying the car through the business, it's an asset. So right away, you can't write off the asset in one shot. The asset is carried on your balance sheet and you can claim depreciation on it over the years.
So which means, let's say the Ferrari's 100 grand, you'd be able to write off 10,000 a year for the next 10 years, let's say, something like that.
Yeah, so you can take depreciation on it. So, you get your write-off over time. That being said, based on, so then the other option is if you lease it, in which, let's say you're making a $5,000 a month payment, which is an expense, you still, in this case, will not be able to write it off because she said that she's not purely using it for business, like she's driving it to and from work. It's not being used to.
So that's a common one, is driving to and from work. That does not count as a write-off, right?
Yeah. You got to be using it to see clients or conduct your actual type of business. So just going to the office is, like, depending on the amount, you might be okay to do it, but it's just going to the office is not considered an expense. Like that's your commute. You're required to do it kind of
Now,
thing.
what if she puts a logo on it?
So if she puts a logo on it, I have had clients do this before. You can write off a portion of it and say that it is a marketing expense towards the
Now, how
business.
big does the logo need to be?
That I don't have an exact measurement, and the Tax Act doesn't specify that it needs to be 5 by 8 or anything like that. But you're gonna have to. The book will say you have to reasonably show that this is actually trying to generate you business. In which I think the Ferrari kind of speaks for itself. But it's gonna be more of a gray area there.
It really sucks because you're not saying what all the Instagram people are saying. You know, like I just saw on TikTok that if I buy a G-Wagon, I can write the entire thing off. I don't trust you, PV. The TikTok guy's right. You must be wrong.
Man. I wish I had better news for you. And actually, the G-Wagon thing's true in the U.S. if it's over 5,000 pounds.
I heard about that, but that's only in the United States.
Yeah, it's only in the U.S.
All right, last one.
Hey Anthony, I got a question for you. I just bought a Rolex. It's about $25,000, and I'm planning on wearing it for business dinners, events, things with clients, whatnot. Give a little bit of a perception that I got some money. Can I write this off?
So we're gonna put this in twofold. So one is buying it as a marketing expense, and two is buying it for a client as a gift.
Okay, yeah. So as a marketing expense, you're not going to be able to write it off. Again, this is something that would potentially be considered an asset in nature or very much a personal expense. Like you're going to have a hard time arguing that it's purely for business in order to write it off. What I have seen some people do, which is questionable, and I'm not signing off on this, but they use the retained earnings in the business to buy the Rolex, and they carry it on their balance sheet as an asset, and it's just sitting in their safe as an investment piece that's never being worn because some of them do appreciate in value. How the CRA is going to prove whether you wear it or not is a gray area, but the book says you technically can't.
That's interesting.
If you're going to sit it, if it's going to be an investment, it has to sit as an investment.
Now, how about as a client gift?
So as a client gift, there's a potential for you to be able to write it off as long as the actual story makes sense. Like if you're buying a client a $20,000 Rolex and you're only making like $20K in income from them, the CRA is going to be very sketched out by that and say,
well, what
this
if
is not reasonable.
So what would justify a $20K gift?
There's not an exact number, but if the story makes sense. For example, if you're making $1 million a year from this one particular client, you value the relationship, so you buy them a Rolex as a thank you for the business, like that's something they would say, okay, cool, it's reasonable. Now, is the amount $1 million exactly? No, but that's a story where it very much makes sense why you'd be buying $1 million Rolex for a guy who's giving you $1 million a year. Sorry, $20,000 Rolex for a guy that's giving you $1 million a year in revenue.
Love that. Thank you. What I like most is now this is my 9th year as being an entrepreneur. And I love that the people that I made friends with in my first couple of years, which includes you, over time, we've built history together.
Yeah.
You know what I mean? And I particularly value that. My biggest mentor, his name's Anthony Lacavera, he tells me the most important thing is your community of people. And you, sir, are a part of my community of people.
you,
and I look forward to episode 100 having you on. You know what I mean?
100%.
But also what's interesting is we get to look back on some times. A lot of people that have been following the podcast for a while, one of the driving forces for why I do this is that I get to put my stamp in time through this technology of video and audio. And it's kind of like crystallizing a moment in this life. And what's cool is we have some clips from past episodes that we've done together that I would love to play back and kind of get your perspective on it, but then also some other clips out there in the social media zeitgeist and get your opinion on it.
Sounds good, man.
Okay. So this clip is from our first podcast that we did together back in 2019. And I just want to get your perspective if things have changed or what you think of it now.
Sounds good.
What are some areas right now as an investor in Ontario that you would look to invest in?
Yeah.
If you
For
want to
me
give me one or
personally,
two,
I
yeah.
really like Scarborough in terms of I think it's an area where if you do duplex conversions and you do have the cash to tie up, it will cash flow. The negative is your ROI is lower than some of these strong cash flowing properties by far.
Blast from the past, man. I'm still bullish on Scarborough as an area and doing the duplex conversions, and there's still money to be made there because you're adding housing inventory, and I think it will do well as an investment for your average person. For me personally, though, I'm very much focused on the apartment buildings now. Like, I still have a couple properties personally that I'm just planning on holding forever, but I've actively not gone and acquired real estate outside of foundation capital because it's going to take time and energy that I don't have systems and processes for, right? So with foundation capital, we buy apartment buildings, we have things in place to deal with the headaches and manage it for our investors as well as ourselves. But if I go and pick up another condo or a duplex in Scarborough,
That's
it's
more work
landlord
for you.
TV who has to deal with the laundry breaking down and stuff like that. So as an investment, I think it still works. I stand by that. But for me, I would not invest.
And even in general, your approach to investing in like a certain area like Scarborough or whatever, what are your thoughts on old PV's advice there?
Yeah, I think old PV's advice actually turned out pretty well since that time. I think the prices there have gone up significantly. I think if anything, the city has gotten more friendly when it comes to approving permits and stuff like that for those duplex conversions, as well as even adding garden suites. So very much in terms of that opinion, I think if you had listened to that advice, it would have turned out really well.
Okay, sweet. Next one. So this is from the pandemic. It looks like you did this one from your bedroom. Okay. All right. We're going to play it and let's see what your thoughts are.
So for us, a lot of our real estate investments have been based off of cash flow more so than appreciation. If you're picking markets where you can continue to get strong rents and the property can not only sustain itself but pay you monthly, that's what a better investment is for us and has typically been a better return, especially in times like this. It's much better to be cash rich than equity rich, because how are you going to go and get access to your equity, especially in a time like this where think there's a lot of uncertainty, the value of the properties could potentially be dropping, things of that nature. So having more cash flowing investments where you can stockpile cash and utilize that to go and purchase is something that helps you hedge in these scenarios.
Nice. Damn, that's a major throwback.
Yeah. What's it like looking at yourself from back then?
I feel like I've changed so much, even just the mannerisms and stuff like that, not just physically. But I do stand by that in terms of, I think when it comes to real estate, cash flow is always king. Like, you never want to be buying a property where you're purely speculating on just the appreciation, right? So, there always has to be at least a cash flow component to it. And what I would add on to that now, specifically in the apartment building space, what we're doing is we're getting both, right? We're getting forced appreciation by improving the operating income of the building, which makes the building's value go up, and it also cash flows. So you get the best of both worlds, which I like. Now, if you're in a different market where you can only get appreciation and speculate, or go cash flow, I would take cash flow.
Hell yeah.
What's the North Star for you? Where are you trying to go? When's enough?
Yeah, that's a question I ask myself all the time. I do have maybe an assets under management goal that I've been kind of workshopping, but for me, I think it's going to be a combination of getting the fund to a certain place and seeing how many lives and investors we can impact as well along that journey.
Nice. Yeah, I think, man, I'm actually impressed. I didn't remember that I was saying that's my North Star, but that is still accurate to this day.
I love that. It's ingrained in you then.
Yeah, 100%. I think in terms of the fund's goal is to get it to at least $1 billion under management. But the beautiful thing is the investors and the lives we change along the way, and giving people that opportunity to build wealth drives me.
Cool. I love that. Let's look at this one.
What are some asset classes or areas that people can be looking to take offense during this period of time?
Yeah, so I think the very popular one that is a low barrier to entry, which many individuals typically tend to lean to, would be the stocks and equities. We've already seen quite a correction in those, and there's still many solid companies who are just as good as they were fundamentally pre the correction that have dropped in value. So, finding some of those good stocks and investing your money in them can be a very easy thing for individuals to do and put their money into. Then you have someone that's doing what I do, which is real estate, which takes a lot more capital. And, with these interest rates now, the loans that you're going to be getting are reduced, but again, if you can afford to purchase them and get good properties, I would go ahead and invest in real estate as well.
Because you might be able to take advantage of some people that are fire sailing because the interest rates have gone past their affordability. That you could be able to get in there and get something on a discount.
Right. So that is one of the opportunities that are definitely present with real estate, especially some of the individuals who may have over leveraged themselves are forced to fire sale, which is unfortunate. But again, that's why people say millionaires are made in recessions, because it's usually a reduced asset sale, which these people are purchasing during the recession.
Man, that stands true. It's funny because at that time, we were seeing corrections in both the stock market and the real estate market. Real estate market, we can kind of more directly put a reason to it. People were over leveraged, forced to fire sale, et cetera. And stocks were just dumping, right? Yeah. So it just goes to show that, the statement stands true is like, be fearful when others are greedy and be greedy when others are fearful. Because
100.
I remember around that time Meta was crashing, and I think it was at $170 a share or something like that, and people were shitting all over it. And now it's trading at like 700 and change, which is a crazy multiple, right? And similarly with real estate, I think when people are running from it and saying the market is shit is when you should be buying good assets, piling it up, and then be potentially in a position to hold forever or refinance when times are good, assuming you can carry the debt.
I can't say it enough that like trying to time the market is not what you should do, and just stay your ground, have a well-diversified portfolio, don't get too scared when things start to go bad, and don't get too greedy or like money hungry when things are going well, and stay the course and you'll be okay.
And the same lesson keeps popping up again and again. This was in 2023, but even earlier this year, remember when we had the tariff scare and everybody was dumping their stocks?
And now,
if you had bought then, you'd be on a good amount of gains right now.
Exactly. That's the funny thing about this is like, we're gonna watch these, and pretty much if we're like wise investors, where our advice is not gonna change, or our perspective is not really gonna change.
I'm sure another thing that you're seeing on social media is the cliche quote of many millionaires are made in recessions. There are those who are prepared for recessions come out significantly ahead, and that is very much true. So if you do put that preparation in and acquire the right assets, this is a great opportunity to come out wealthy as well.
Yeah, man, I love that, and I still stand by that. Actually, what's an interesting change that I've made since then is, in general, as an investor, we tend to not like to sit on cash. When your cash comes in, you deploy it and you want to put it to work. But I found myself in situations where I've put all the cash to work, that when a golden opportunity does come, like in a recession or a big downturn, it's harder to acquire the cash to take advantage. So I think always having access to cash, whether it's through a line of credit or maybe you keep a portion in some sort of liquid asset that you can quickly liquidate in order to take advantage, is important.
That's a hard thing to do.
It is.
It's really hard just to have it sitting there, not do something. It's something that Warren Buffett is famous for. Everyone always critiques him for having a large portion just sitting in cash, and everyone's like, is Warren Buffett lost his touch, and then boom, opportunity comes, doubles down on it, and then everyone's, no, he's still the GOAT.
Yeah.
You know what I mean?
Agreed, man.
All right, last one.
What's one piece of wisdom that you wish you learned a lot sooner?
What's one piece, I don't know if this counts as wisdom, but one piece of knowledge that I wish I had much sooner that could change so many things would be understanding how debt works and how you could use it is something that the wisdom around that I've essentially gained over time, through the real estate game, but also through being an accountant, et cetera. That understanding and ins and outs of how that works, I wish I knew much sooner, because if you know how to use debt properly, you can scale your business or hustle or real estate investing, or asset class investing so much faster.
Yeah. Wow. Honestly, man, I like that, and I would just maybe kind of branch it out a bit and say capital leverage, whether it's debt capital or equity capital, learning how to use that leverage properly, and the economies of scale that comes with that can grow your business so much faster.
Especially because a lot of people are taught from our older generation to be fearful of debt, right?
Yeah.
On the other hand, though, people get in trouble with debt, right?
Sure. Yeah.
So it's kind of doubling down on something that's already working and proven in order to amplify that is the concept of capital leverage.
Yeah, exactly. And even a more simplified example of this was like me and my partner, we built our accounting firm before from the ground up and grinding the same way you grinded your agencies, lawyers, everyone who has some sort of public practice. They tend to build it up themselves. But after having gone through that journey once, I think the next move would be use capital leverage and then just go out and buy firms and acquire them, and you can do it at a much bigger scale. And but the key is the execution has to be there. So you need to know what you're doing first. So maybe you build your initial one up to a certain point, and then from there, instead of chasing the organic growth, use the power of capital leverage and just snowball it.
And buy, because then you're starting from a position that's greater than you would have.
Mm-hmm.
If you want to get out of debt, you got to get sick and tired of being sick and tired. You got to decide, I'm not playing the normal person's game anymore. Les Brown, the great motivator, says people change their lives when they finally say, I've had it. Enough. I'm not doing this anymore. That's when you'll change your life, and not until. For many years, it was so interesting to me that when I found someone was that visceral about it, they were just pissed off. I'm tired of being beat down by these stinking banks. I'm getting out of this. They were the ones that get out. And the other ones that want to have an intellectual discussion about the mathematical implications of, oh, shut up. They never make it. So I have people with making $100,000, $150,000 a year, they have $40,000 in debt, and they go, oh, we can't get out of debt. You don't understand about the cost of daycare. You don't understand about the cost of, we've always got a reason, we're just stuck. And I meet people making $40,000, they got $100,000 in debt, and they stand on the stage going, I'm debt free. I'm going, how'd you do that? That other guy said it couldn't be done. And all it was they believed it, and they didn't care what anybody thought about anything, and they were gonna go for it. And I couldn't quantify this because it is 80% behavior, I know that, but I couldn't quantify this. Visceral reaction was correlated in our data statistically with whether they got out. You would think mathematically that if you made more money as a ratio of your income to your debt, that it would be easier to get out, because mathematically it is. It has nothing to do with whether you're gonna get out of debt. Your shovel to hole ratio helps. More income versus the hole you're in, your shovel versus the hole you're in, that ratio matters mathematically, but it is not the primary indicator that indicates to us whether you're gonna make it out or not. It's something down inside boiling, and you're just like, yeah! When you get that thing going, nobody gonna stop you. You can even do all the stuff I teach wrong, and you'll still just, Hulk comes out, right? You can't be stopped. If you wanna get out of
Interesting. I'm not sure I approve of the rhetoric, but I would say that a couple things kind of like stand out to me from that clip is obviously Dave Ramsey is someone who like everyone, he has a big following. I didn't know he was that like rah type of guy. I thought he was a little bit more stoic and like analytical. Guess not. But something I always talk about is that, in finance school or accounting school, 95% of what you're taught is the analytical, and 5% or 10% is the emotional or behavioral aspect. But in real life, when it comes to finances and financial decision making, it's 90 to 95% behavioral psychology and 5% the actual technical numbers. So I think he's right in that regard, the way he said it. Funny and motivational. And I think it is the actual managing of your emotions, your behaviors, and understanding your biases that make people fiscally and financially smarter than and wiser than other people. The second thing that I thought was really interesting was the concept of like making more money, which I think is completely irrelevant to the amount of money that you have. You know, the classic thing is it's not about how much money you make, it's about how much money you keep. And the concept of lifestyle creep, or the more money that you make, the more your lifestyle expenses goes up, becomes a real thing without you even noticing it. And I've seen, while working at the bank, I'd see like janitors come in that had millions of dollars, and plastic surgeons come in that were millions of dollars in debt.
Yeah,
right?
exactly.
And then the third thing that I was going to say about what he was speaking about is the general zeitgeist of Gen Zs and millennials being like, I can't save money on $100,000 a year anymore. You can't do that, right? But Gary Vee had a great clip where he was just like, yeah, you can. Because those same people who say, oh, I can't save money on $100,000 a year, buy the latest iPhone, have new sneakers every single month, travel to find themselves, and eat out, buy lattes, and da-da-da. And like our parents' generation, they made adjusted to inflation the same amount of money, but they just never went out, never bought anything, went to work, went home, saved money. And that's just like not in the cultural norms of our generation, which makes people believe that it's not possible to keep up or buy a real estate property one day, you know, like the whole concept around like our generation is never going to be able to afford real estate, I think is a myth and misinformation.
Yeah, I agree. I think there's always a way. It's getting more difficult, and you need to be more disciplined and make decisions early on in life to set you up, you know, but I think it's still very doable, and there's always a marketplace and areas where you can do this and achieve it. The other thing I'll say about that clip is the way he's screaming and yelling at those people. I feel like he's addressing the types of consumers who are purely taking on what I call bad debt. Like, this is debt to fund your lifestyle, fund expenses, car loan for a car just to look cool, etc. You know, that's considered bad debt. But if you're using debt to buy assets, which are actually going to appreciate in value or yield you a cash flow and can not only cover the debt payment, but also put additional profit in your pocket, that's what's called good debt. And, you know, you should be willing and open to understanding how good debt works and how you can leverage good debt to get ahead.
100%. It's a good point to make that, because he was talking about all of the people that buy consumer debt, things that don't go up in value, right? But having $100,000 in debt on property, not that bad of a thing.
Yeah, exactly.
Okay, so let's wrap here. Bro, it's been an absolute pleasure. I could literally sit here for an hour, another hour speaking with you. But one last thing that I'm going to ask you is, I asked you this last time, what's one piece of wisdom that you wish you knew a lot sooner? But what I'm going to ask you this time is similar, but over the last 2 years, looking back, what would you have done differently over the last 2 years, knowing what you know now?
What I would do differently, knowing what I know now, is when it comes to the social media and the marketing and kind of the sales of your business, is being more authentic and true to who you are. I think before, especially with my content and stuff like that, I was hesitant to post things that were non-real estate related or had nothing to really do with my product or my business. But I started doing a lot more things, just showing who I am as a person, and if people connect with me, they connect with me, and just being authentic in that way. And I think that has, you know, not only paid dividends, but made the social media thing easier and something I look forward to, and it's just working in general too. So I think, you know, as I was saying earlier in the podcast, we've been down this journey of figuring out the sales and marketing for the business and how to best do that. I think that authenticity piece has really been a game changer.
Yeah,
so don't overthink.
Showing a little bit more of your personal side and stuff like that. And I like the point you said, how it actually makes it easier, because then you're not like trying to like act or like be someone that you're not. And if you're doing it more authentically, then creating content is less of a chore and more of just like something natural to you.
For sure, yeah, definitely.
PV, my brother,
Thank you,
absolute
bro.
pleasure.
I appreciate it, man.
I want to thank Valentina, Anthony behind the camera, and Tanya and Mark, everyone who put this episode together. Don't forget Brad Lee, who came up with the great questions and actually mapped all of this out. This was your first one producing the podcast, right, Brad? And he did a pretty fucking good job.
That's cool.
Anyways, thank you everyone, especially who's listened this far into the podcast. Until next time, Valentina,